This message is brought to you by Nuveen. What does it mean to invest like the future is watching? As one of the largest global investment leaders managing $1.3 trillion in public and private assets, Nuveen is uniquely positioned to take on tomorrow today.
Combining over 125 years of deep expertise across income with innovative alternative solutions, Nuveen adapts to the needs of investors as they change, offering reliability, access, and foresight to its clients, communities, and the global economy, all in the pursuit of lasting performance. Nuveen, invest like the future is watching. Visit nuveen.com/future to learn more. Investing involves risk. Principal loss is possible. Welcome to Animal Spirits with Michael and Ben. Michael, one of my all-time favorite stock charts. I think JP Morgan is the first one that did this. It shows the annual stock market returns along with the intra-year drawdown to get there. And it typically shows, even when there's gains, there is a drawdown on the way there. This year is a perfect encapsulation of that. This isn't even just the drawdown. This is the year-to-date returns as of April 8th, 2025. The S&P was down 15%. NASDAQ was down 19%. Russell 2000 was down 20%. This is year-to-date returns, okay? EFO was down 4%, and the emerging markets were down 8%.
Holy
Nikes. Now the S&P is up 18%. NASDAQ up 23%. Russell up 14%. EFA up 28%. And emerging markets are up almost 35%.
So the Russell,
look at the spread.
The Russell was down 21 and now it's up 14.
Yeah.
I mean, the NASDAQ's the biggest one, down 19, now up 23. Unbelievable. Really? Huh. Wow.
Staying the course worked again.
It usually does. 60% of the time.
Usually, that's a good caveat. Usually.
It works every time.
But I think if your default is staying the course works, and then one time it blows up in your face, or 3 times over the course of your career it blows up in your face, I think that's okay. And then you still stay the course, right?
Yeah. We talk a lot on the show about like these Dietrichi stats that are internal market indicators. Like, and you know, I'm a sucker for these. Whenever there's a washout and sentiment is in the toilet, and then you get this, I guess in this case, this wide breadth thrust.
You know, it's funny because a lot of these indicators were flashing green coming out of the April downturn.
Yeah.
And we were like, are we sure we believe, or most people are like, are we sure we can believe these?
Hang on. I think go back to the tape.
No, you were a believer.
Yeah.
I'm saying a lot of people were skeptical, like, oh, okay, sure. That was then.
Yeah.
This is a new environment now. There's a lot of people saying that.
Yes, that's true. Because we haven't even seen the impact of the tariffs. And you're gonna say that was the bottom? Yeah, no, that was fair. But we don't often, in fact, I think we usually don't revisit these data points. So the at Cycles fan brought it back up. Reminder, the breadth thrust was triggered back on April 24th. 6 months have passed since the signal, and the S&P 500 has gained 24%, makes it the 4th best in history. And if you look at this from 1950 to today, 6 months and 1 year later, green 100% of the time. Now I'm eyeballing it. There's, 15 times. And what this is measuring, I don't know the exact quantitative metrics. It's really not that important. It's when you've got a significant washout, whether it's measured by percentage of stocks under the X moving, whatever it is. It's a quantitative metric. And then when that condition exists and there's no more sellers and everybody says, oh shit, back in the boat, usually that back in the boat moment happens for a reason that matters. And this is the technical analysis that I'm a fan of, because this is quantitatively measuring human behavior.
So if we had the washout and you didn't get this big thrust of buyers coming in, then it would have been like, okay, this is something to continue to worry about.
Yeah, for sure. Rob Anderson, who does great work at Ned Davis Research, posted Tech's 66% gain off the April low was the best 6-month return for the sector outside of 1983, 1999, and 2000. Look at this. So he has a chart that shows 6-month rate of change, 3-year rate of change, and 10-year rate of change. And yeah, 6 month. Wow. Just
I mean, that's like the gain we saw off of the 2009 bottom over this amount of time.
You know, it is
crazy.
It's a good thing. I'm thinking of this as I'm about to say it. Let it fly. It's a good thing that Liberation...
You can argue with yourself later.
Yeah, I'm thinking about it. It's a good thing that Liberation Day, the deliberate disruption happened in the stock market.
But we talked about this at the time. We're like, is it possible that kept us from? But obviously, it hasn't though.
But who's to say? Well, I was about to argue with myself because who's to say in an alternate universe where this didn't happen? It could have just been a slow, steady grind higher. It didn't have to be an explosive move. Who knows? But it is possible that absent that, no hiccups whatsoever, that the Nasdaq is up 40% year to date, and now we're really talking about a bubble. Like, oh shit.
Yeah, right. We just kind of pushed it back for like 3 or 4 months, and then it kept going.
Ben, you had Chart Kid make this very good-looking chart that shows the number of companies in the index that outperform on a calendar year basis. And the immediate thing, well, two things stand out. Number one, the number of stocks beating the market the last 2 years, almost off the charts low. We saw this in 98 and 99, dun, 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 with narrow leadership. And of course, all of the money is being sucked up by the hyperscalers. But when I see this chart, I sort of go, like, I think be careful what you wish for. For people that are wishing that it was more stocks and a rally broadening out, and because the most stocks that outperform the index happen in crappy markets. And we've spoken.
Right, 2022.
Yeah.
It was almost 300 stocks.
Look at 2001, 346. You want that? Great. 346 stocks outperformed the index.
But in the mid 2000s, when the bull market really took off, 2013, 14, 15 was a bad year. 16 and 17, a decent number of stocks took off. That wasn't that bad. But here's the thing I took out of this. I thought the number would be way lower because you hear
lower than 152. How much lower could it be?
I'm saying the average. The average is roughly half of all. So call it 45% or so of stocks outperforming a given year. I thought the number would be lower because if you look over the long term, the number is tiny, right? So I guess here's my biggest takeaway. More active managers should outperform in a given year than do.
True.
But here's the thing. If they just bought and hold, if they just bought 150 stocks at the beginning of the year, how many ever they hold, and held and didn't make a single trade over the course of the year, they would have a better chance of outperforming than they currently do.
Two things. Gross of fees, managers' track record is way better than what is reported. Number two, I think you just muted yourself. Number two is, and I've said this a million times, the best bidder study is real, it is in the data, and it rightly makes a case for index funds. And also, it overstates it a little bit because it is acting as if people buy the IPO and hold forever, and it's ignoring the fact that, listen, sometimes there are opportunities to buy and sell stocks at different points in the cycle. So a stock can fall 80% and be a dog shit company, go to zero. A stock can be down 80% to be up 400% the next year and provide potential opportunities for alpha. So both things can be true.
Right. You could have bought Peloton and held it until the beginning of 2021 and made a ton of money and sold before it crashed.
Right.
And you made money.
Right.
And that's here's my thing though. And this is not groundbreaking. I think picking the stock pickers that outperform is way harder than picking the stocks that outperform. That's my takeaway here.
Well, I mean, I guess it depends. If you're trying to pick a stock picker that could, if you're doing it every January 1st, yeah, I mean, that's impossible.
How many stock pickers have we had in the last 20 years that you can point to that you go, that person's going down in legendary status? They used to have those all the time. They don't happen anymore, really.
Yeah, too hard.
It's more thematic than anything.
It's too hard. Okay, this has been the rallying cry of people who don't want to believe that stocks might be in a bubble. It's like a warm security blanket. Well, it can't be a bubble if everybody thinks it's a bubble. It just can't be. Oh, really? Why not? So, I listened to, by the way, Ben and I stumbled a little bit on the ad read, and I joked, reading is hard. Reading is hard. I listened to Andrew Ross Sorkin's 1929, which I really appreciate that he read that. I can't imagine how difficult that is.
It's a very long book too, and he's a good reader. Here's the thing. So my publisher asked if I would like to read my book. And at first I said, no, I don't want to. But then I thought, wait, I probably should read my own book. But it's going to be so hard. I'll trip up a million times.
I can't read out loud for too long because there's something in my face, my gland. I produce excess saliva. I can't do it. I can't even read books to my kids for more than 10 minutes.
there's certain words that always trip me up, and I can't get whatever they are. I can't say them correctly.
So anyway, in Sorkin's book, which was tremendous, phenomenal, kudos to him. There were people that said, "Wait a minute, the Fed has to raise rates. This is crazy. How are you allowing this speculation to continue? It's going to end badly." Okay, right. That was in 1929 when we knew very little about the securities market. Modest Proposal tweeted, "I'm begging people to go back and read the contemporaneous reporting of the housing market from the spring of 05 to mid 06. It was meticulously documented by the mainstream press how insane consumer behavior was and how prices subsequently began rapidly declining." So people are like pretending that
there was like Time magazine cover stories about people going nuts for their houses.
Yeah, and you don't think in the late 90s that people had any inkling that things were a little bit of a miss? I mean,
there's plenty of people.
Yeah.
The thing is, like you could say the 90s, the overwhelming number of people were on one side of the boat saying like, "Oh, this is great. Things are going to be great forever." But there was plenty of other contrarians who were saying, "No."
Yeah. So anyway, if you're using this as like blinders to say that, "Oh, it can't," listen, everybody knows it's a bubble, can't be a bubble. Not true. And I'm not saying it's a bubble. So don't mishear me. But I'm just saying that argument to me is hogwash. It falls on deaf ears. It's not credible.
And the other thing is, I think you get into this rut where you go, well, listen, in 2022, everyone said we're going to have a recession. Everyone, 100% chance. Didn't happen. So this time is the same.
Now to the extent
guess what? Bubbles can and will happen.
To the extent,
and this probably, you say can't say yet. Let's be honest. This is probably a bubble.
Then why do you own stocks?
Because why would you sell stocks in a bubble? I'm George Sorosing this. No, that's why I'm diversified.
Yeah, good point. No, but here's the other thing about like, people are talking so much about the B word. Yeah, because nobody wants to look like an asshole. Anybody who talks in front of a mic, ourselves included, with this guy just throwing out the Grand Rapids hedge 10 seconds ago, I don't want people to, nobody wants that feeling that how could you be so oblivious? How could you guys not know NVIDIA at 4 trillion? How could you not know that Oklo, this company that had nothing at 20 billion? How could you have missed it? Right? Nobody wants egg on their face. And so people are being extra cautious about not looking like an a-hole.
Yes, that's what everyone has to say. Like, this is a bubble, but I'm going to keep riding it.
Right.
As the melt-up happens.
No, it's a bubble, but it's totally justified.
So speaking of the 1929 book, someone on Twitter asked us, watching you and Michael talk about the trillions of inflows in index funds came from, what about credit? We were asking, like, where's the money coming from?
Okay, part of the story.
Are people buying on a margin? And he said, yes, I've been reading 1929 as well.
Yeah.
If you look at this is from your Denny research I pulled. If you look at margin debt versus the stock market, it's going up in a straight line just like the market. And you go, oh my gosh, yes, people are borrowing tons of money. However, if you look at margin debt as a percentage of the stock market, it's actually dropping. You see this one, the second chart? This is the one that always gets people.
Oh, yeah. Great stuff.
The margin, so it's not, people aren't going nuts.
No.
And they did
people
in
aren't
the 2000s.
People aren't going nuts. And I guess just to broken arrow this, belabor the point, to me, a bubble is an 80% decline with no recovery. That's the aftermath of a bubble.
No, not no recovery.
Fine, a modest recovery, a 15-year, a 20-year recovery.
Okay. And that's what happened to tech stocks after the dot-com bubble. It took the NASDAQ 13 years to recover, and it was an 80% washout.
Okay, and it took stocks from
80% is a big line. I think 50 is okay enough for me to call a bubble.
No way! No way!
Even Japanese,
dude, what are you talking about? These stocks fell 50% in 2022.
Japanese stocks,
Amazon and Amazon,
the NASDAQ was down 34.
Amazon, Google, Meta, and NVIDIA. Amazon and Google fell 50. Meta and NVIDIA fell 75%.
Yeah, but
75.
They didn't have the second part of your thing, though. They recovered immediately almost. They recovered within 2 years.
50% proves nothing. Pull up a chart of Amazon and Apple. Look how many 50% declines they've had. That proves nothing. Listen,
I think the recovery is a part.
1929 to 1954. That is a bubble that burst and took...
Listen, Japanese stocks fell 60% in total. They didn't fall 80.
Fine, and it took them 90 years.
That's what I'm saying. It's the second part. This is by 2022. The washout happened, yes, but those stocks recovered very quickly.
All right, Cisco, it took 25 years to recover. The financials,
that's what I'm saying.
A lot of the financials took 15 years to recover after. So if NVIDIA falls and takes 15 years to recover, then it would have shown to be a bubble. But if it falls 50% and then it captures and then it bounces 30%, that's not a bubble.
That's the weird part
That's
about
an
this, though,
overpriced
is that
stock. That happens all the time.
my
And a bubble. Thinking about like the scary part of this, bubbles bursting, there has to be an element of a complete loss of faith in the system. And that shows itself in credit and the lack thereof. People unwilling to loan money. That is what is so dangerous about the debt and the debt that we're talking about, is that when the faith of lenders goes away, then you get some nasty shit. But the equity getting falling 40%, that tells you nothing.
No, the only way this is a true bubble is if AI is like, it takes like 10 or 15 years for it to actually come to fruition. Because you could say this is my Grand Rapids hedge here is this is a capex bubble. Okay. But the thing is, even if there's a washout in the stock prices, the amount of capex that they're putting into this, it's going to work eventually, it sounds like. Let's say it's on a 5 to 7 year lag at the worst. Then these stocks are still going to be, they're not going to languish forever.
Yeah, capex bubble, that's fair. That sounds right. It definitely feels like there's definitely some shit. What's this 5x ETFs?
Okay, Business Insider did a story on this, and they interviewed someone from Morningstar. Can't remember who said it. So they're talking about the 5 times ETFs. 55% of leverage ETFs that have launched have closed already. Of the couple hundred that have launched, 17% have lost over 98% of their value. So sometimes these things are okay. Most of the time, they're completely horrible for you, which makes sense. And I don't think most people are getting into 5-time leverage ETFs thinking that like they have anyone to blame it themselves if something goes wrong. Yeah,
but I think at this point, if you don't know, shame on you. I think people know.
Yes, but the people who use them love them, I'm sure.
Yeah, good.
Which is okay.
All right, a chart from Augur Infinity shows soft data versus hard data. And it shows that the soft data is rolling over again pretty dramatically. I don't really want to spend more than 10 seconds on this because I'm just happy that we sort of, this went away for about 12 months. We haven't spoken about it. Maybe it's back, maybe it's not, but
I'm still of the opinion that vibes are broken forever and sentiment readings are nearly impossible to take any signal from the noise.
Okay, well then what do you say about the recovery? Was that broken too?
Just look at the swings in these things. The mood swings are manic.
They don't mind they're on the downside. When people say that they're depressed, don't worry about
it. But look at how quickly people went crazy and euphoric in January 2025, then it crashed immediately. I think that the swings are way too wide to take these as.
Something happened around there to make people feel upset.
Okay. Here's the new story of the week, I think, from the economy. This is from the Wall Street Journal. More big companies bet they can still grow without hiring. And I found this, and they talk about how JP Morgan said they don't need as many people. Goldman Sachs sent a memo. Walmart. There was a story about Amazon yesterday getting rid of a bunch of white-collar employees. The Airbnb CEO says this. It's just kind of funny to me. Whenever you're in these cycles, it feels like they are going to last forever. And I pulled up a story from 2021. 4.3 million workers are missing. Where did they go? Many economists expect the labor shortage to last years, and some think it could be permanent. Okay? That was 4 years ago. Economists think this labor shortage could be permanent. Now we don't need labor anymore. We're done with them. I just want to, there's going to be overreactions here. And I tweeted this out this morning. Here's something I believe. I think 3 things can be true. 1, AI is going to disrupt many jobs, and many of them we don't even know right now. 2, companies are going to use AI as an excuse to lay off staff that they're going to lay off anyway. It's a great scapegoat. Who do you blame for AI? Technology? Like, who do you yell at?
Right.
Sorry, AI. And 3, I think there's going to be many companies that take this way too far and realize, oh shit, we did not mean to let go of that many people. We need to bring them back. There's going to be stories in the years ahead of rehiring because AI didn't do what they thought it was going to do.
Yeah.
How's that?
Yeah, I agree. Good takes.
I think that's the cycle we're on here. It's going to, like, there's no way you can pinpoint the exact number of people that AI is going to help replace, right? It's impossible. There's going to be tons of back and forth on this.
Yeah.
In tech companies that overhired, listen, a lot of places overhired in 2021, 2022, and 2023.
Yeah.
Because people were worried that they couldn't hire anyone, right? There was all those job openings. And now I think it's like, this is the other side of that. Like, let's get rid of them, just blame it on AI.
This is going to be the dominant economic story of the next couple of years. This is going to be all we talk about, unfortunately.
Yes. And when there is a recession, people are going to worry, well, are they not going to rehire me? coming out of the recession, am I never going to get rehired because AI? Like these are going to be the stories we're talking about for years and years.
Yeah.
All right. This is interesting. I feel like you talk about with inflation, like the price of restaurant orders, right? Saying like, remember we talked like, what are the things about inflation that really still get you? And you said paying $20 for a salad or something, right? Or some. So
people don't get over that. They're still not over it. Who's like, yeah, a salad with grilled chicken costs $24 and I'm cool with it.
The thing is, I think no one is cool with it, but everyone's still just like, whatever. So this.
Well, what are you gonna do? Not eat? What do you mean?
So this is a story from well, you could brown bag it. This is a story from Market Watch. Why are we normalizing?
Have you been to the grocery store, Benjamin?
Why are we normalizing $20 lunches? So this is from a survey, so take it for its worth. But it says Americans are spending $108 each week on their Monday through Friday lunches. That's up from $88 a year ago. Obviously, that like take these with a grain, but that number doesn't sound shocking to me. If you go out to eat every single day and you spend $100 in a week, that number probably would have been shocking 10 years ago. Today, it's not shocking at all.
Okay. Well, it depends what you eat. I mean, Chipotle is $12.50 in New York City.
That's your bellwether, is Chipotle.
I mean, that's not bad. It used to be $14, I think. $12.50.
So look at this next chart here. I pulled this from the U.S. Department of something. I can't remember. And it shows U.S. food expenditures, and it shows food away from home, eating out, obviously, and food at home. And you can see in the past 10 years or so, food away from home has taken the lead. They used to be right on the same trend line. Food away from home is skyrocketed over food at home. It is now almost 50% more. Are you going to say
that food away from home used to be underpriced?
Oh, no. I'm saying people have just changed their habits so much that everyone complains about the price of stuff, but you still would rather pay for convenience.
Oh, wait a minute.
Than change your habits.
This doesn't show like the price of food at home versus the price of, this shows how much people are spending at home.
How much people are spending. Right. So people are spending, and obviously you could say, well, a lot of that is the price, but people are obviously willing to pay higher prices to eat away from home because of the convenience. You complain about it, but then people don't change their behavior.
Right.
I think that's what we've learned about inflation.
Yeah.
And that's why I think the next recession is going to be so fascinating, because are people actually going to change their behavior and slow spending, or are they just going to borrow a bunch of money? Because I don't think we have the ability to change our behavior as consumers. I just don't think we have it in us. That's where I've fallen on this. We're going to spend the certain amount of money regardless. Hey, cars are 50 grand. I don't care. I'll take out an 84-month loan. Same monthly payment.
It depends. I mean, what you're saying sounds crazy, but it's not that crazy, because you're right. People don't change. It depends on the depth and the duration. Listen, if there's, God forbid, a recession in the last 7 years and it's painful, yeah, people are going to change their behavior. If it's a 2-year, relatively mild recession where unemployment goes to 6%, then probably you're not going to see much.
That would be my base case, is that if we get an AI-led capex recession, hey, Mark Zuckerberg spent $400 billion too much, it's going to lead to a slowdown. To me, that's a mild recession.
Yeah.
Right?
All right. Chart from Goldman. Tariff effects seen so far imply that U.S. consumers will eventually absorb 55% of the tariff costs. All right. That's a projection. For right now, it's 37%. Businesses are eating 51% of tariffs. I am not an economist, but I feel like the argument against tariffs were pretty cut and dried. It's like, listen, this is a tax on consumers. Like, this is a thing. And were we all wrong? Like, is it not a thing? How is it? I'm sort of over the just wait, it'll show up in the data type of thing. I mean, it's been 5 months. And yeah, no, it's not there. It's 37. We're bearing 37% of the brunt, but it hasn't seemed to really make a big dent. Now, listen, are there businesses across the country that are getting destroyed?
That's the thing. It sounds like small businesses are taking the brunt of this, as opposed to consumers.
Yeah, so maybe it's just not showing up in giant American earnings.
Right, we didn't get $4,000 iPhones like people thought.
Yeah.
Right. I trained my kids how to build an iPhone in the backyard in our factory, and that was a waste of time.
Yeah.
So here's the thing: in the next recession, if we get one in the next couple of years, guess what? Tariffs gone. That's the stimulus. That's one of the pieces of right.
Tariff, yeah, take away the tariffs is like is like when your kids graduate from nursery school. Not nursery school. What the hell do you do?
Right.
What's pre-nursery?
Daycare.
Daycare. There
Yeah.
you go. Yeah.
Yes.
Like boom,
Yes.
an extra few dollars in my pocket.
Oh my gosh. I had 3 kids in daycare for 2 years.
That was stimulus.
It was huge stimulus
Yeah.
to the Carlson household. But yeah, you're right. Don't you think in next recession, the tariff, all right, hey, guess what? We're taking off the tariffs. Or do you think they're going to be too like entrenched at that point?
I don't know.
All right.
Kai Wu is, in my estimation, one of the best research reporters out there. He's not a reporter, but research writers. He's an investor.
Can I make an analogy here?
Sure.
Kai Wu is the millennial Michael Mauboussin.
Yeah, that's great. Well done. Nailed it. Okay.
Right?
So Kai is one of those people, and it's a very short list. I would say it's Kai and Semblus for me, where it's like paper out, I read it. He has a way of turning the story inside out and creating charts that you just don't see anywhere else. So he wrote a piece.
Oh, wait a minute. Hang on. You read this whole piece. I did too. You didn't come away thinking, okay, this is a bubble. When you look at all these charts, a capex bubble, there's no way you could read this piece and not come away thinking, yeah, this is a capex bubble. Come on, what are we doing here?
It's different.
Of course it is.
Ben, it's different this time. No, it is a capex bubble. Yeah, they're spending a lot of money. It is a capex bubble.
Yes. That's a great Grand Rapids hedge though, right? Capex bubble.
Yeah, no, it's not a price bubble. What? No, it's all right. So he looked at the capex as a percentage of GDP for railroads, internet, and AI. And this has been done before, but what Kai did that is so interesting is he depreciation adjusted it. So these data centers, they go. Like they need constant maintenance. They depreciate it. It's hardware.
Right. You put the railroad tracks down, they're there for a long time.
Right, exactly. So when you depreciation adjust it, you get one of these. Yeah, let me get a cringe face for people that are listening. Yeah, no, it's high. It's a lot. And the thing. So he did point out, which I love, that these companies, the Mag 7, are so much better than everything else. And I know we all know that. Nobody's disagreeing with that. That's why Nvidia's $4 trillion and Apple's $4 trillion.
These are literally the best companies that we've ever seen.
Yeah.
Ever.
So, all right. So he breaks it down like this: return on invested capital, which is like the metric of metrics, right? How much money do you make per incremental dollar of spending on all of your investments within the business? That's it. And the Mag 7 are at 22.5%. I don't think there's ever been anything like this in the history of business at this size.
It was all capital intensive before.
The S&P is at the S&P 493 is at 6%. Return on equity 30 versus 13. Free cash flow margin 16 versus 9. Now Kai says again, justified. These were incredible, asset light, high margin, wide moats, all the things. But now,
hang on, before we get to this, so he says, since 2015, the Mag 7 is up 27.5% per year, creating over $23 trillion of wealth for their shareholders.
Unreal.
Guess what? The fundamentals worked pretty good.
Yeah. But now they are transitioning from asset light to asset heavy. And Kai looked at the history of these asset heavy versus asset light companies across time within every sector.
Right. Now they're investing in data centers, and these are real physical things, not just software.
Right. And companies that spend a ton do not perform nearly as well as their counterparts. And he did, of course, use one comparison to 2000 as you got to do it. He showed, is this Cisco or something else? What is this? Are these telecom stocks? Let's call it telecom stocks. So the thing is, they did grow. The promise was there. The fundamental growth. So their sales increased at the peak from 2000, 1,030% over the next 20 years. 1,030% sales growth. The problem is the multiples contracted 85% because the multiples were so insane that you got a total return of 16% over that 20-year period, with obviously a dramatic fall in between.
I don't remember the exact numbers, but Microsoft, when Ballmer took over, he took over in like 2000, and Gates got out right at the right time. And the earnings growth for Microsoft was like massive during Ballmer's tenure.
15%.
And the stock got crushed his whole tenure because of where it started.
Now, the companies today do not have nearly the same insane multiples, okay? NVIDIA trading at whatever it is. I don't know if it's 35 times forward. It's not insane. Okay. Now, if the multiple goes down to 26, yeah, you're going to feel it, but you're jumping out of the third story of a building instead of the 10th story, like these stocks were back in the day.
Yeah, so just some broken ankles, you'll be fine.
That's it. Just exactly.
The thing is, he puts the quotes in here from Zuckerberg and Larry Page about like we're willing to go bankrupt rather than lose this race. What do these tech CEOs care if it's a bubble if they're trying to create AGI or whatever? Like, what do they? Why would they care? So what?
I guess what's different, and I wasn't around during 2000. I don't know what the CEOs were saying, but they're being very clear about what they're going to do, what their plans are, and investors are saying, we're riding with you.
Right. And how long? That's the thing.
Now the question is
for investors to say how long.
And we're getting an earnings call. We get them all reporting this week. I'm sure at some point, maybe it's this one, maybe it's 5 years now, who knows? At some point, investors will say, buddy, you've been saying this for 9 quarters. Show me the damn cash flow.
All right, so good segue here. So did you listen to this part? I think this is the podcast of the year so far. I listened to this. I got to be honest. I had never heard of this guy before. I listened to it. But it's so Dwarkesh is the podcast. Did you listen to any of it? Did you put it in ChatGPT at least?
No.
Okay, it's a 2.5-hour podcast all about AI. And this Andre Karpathy, I don't know how to say his name. He was one of the founders of OpenAI. He led Tesla's AI division. Now he does some other educational AI thing. I've got to be honest, I didn't understand 65% of what he was saying, but the stuff I did understand kind of blew my mind, and it was fascinating. I gobbled this thing up in a 2.5-hour podcast in one day. Here's a few of the things I pulled out here, okay? Now, this is really good. So his whole point is AI isn't going to supercharge GDP growth. It'll just keep us on the same trajectory. He's like, listen, just like the internet and email and all these things that came about and automation kept this long-term 2% trend line, that's what AI is going to do. It's just going to keep us on. It's a step of that automation in the same direction. So he's like, it's not this leap forward, this huge leap higher. It's just going to keep us on the same trajectory. Now, without AI, maybe that trajectory flattens out. But with it, that's his expectation. He said, listen, I can't predict the future, but that's my sense. So he says, with AI, we're going to see the exact same thing. It's just more automation. It allows us to write different kinds of programs that we couldn't before, but AI is still fundamentally a program. It's a new kind of computer and a new kind of computing system, but it has all these problems it's going to diffuse over time, and it's still going to add up to the same exponential. We're going to have the same exponential that's going to go extremely vertical. It's going to be very foreign to live in that kind of environment. He was like pouring some cold water on this, but also saying like, this is going to be amazing. It's just not going to happen as the way he explained LLMs, like AI, was really interesting. He said like, we would love to be able to create an AI that's like an animal, like a zebra comes out of the womb or a horse and it can walk immediately and he's like, we can't recreate that. An LLM is like a ghost is how he explained it. Like that's how they view it when they're trying to like build these things. And he says AGI, which he thinks is like a decade away, which is kind of funny. People were kind of like, oh, really? A decade away? That seems way too long. It's like you're creating like, some people say God in a box. Like, oh no, we have to wait 10 years for it. But he says he put a little cold water on that too. He said some people feel like this assumption we have God in a box and now it can do everything, and it just won't look like that. It's going to be able to do some of the things. It's going to fail at some of the things. It's going to be gradually put into society, and we'll end up with the same pattern. That is my prediction. This assumption of suddenly having a completely intelligent, fully flexible, fully general human in a box, and we can dispense it at arbitrary problems in society, I don't think that we will have this discrete change. I think we'll arrive at the same kind of gradual diffusion across the industry. Now, so this stuff all sounds like he's pouring cold water, right? But he's still saying like the stuff that's going to happen is going to be amazing. It's just not like, it's not world changing like people think it's going to be this total step up in everything is completely different. He says we're on the same trajectory. Thoughts? You got to listen to this. It's really well done.
I don't believe him. We already have self-driving cars. The robots are coming. The world is going to change. Now, if you're looking at a line of GDP growth and saying, did the world change? I don't know. I would suspect that you're going to see something, but maybe you don't.
That's the thing. The internet did not change the trajectory of GDP.
Okay. Maybe so. But I think that this is going to have radical transformations for our daily life, for the way that we do a lot of things. By the way, I would assume that he would say that too.
Yes.
Okay.
Yes. I just thought that it was a very balanced, it was one of the more balanced looks I've heard from a guy, again, I'd never heard of before I listened to this podcast. So take that for what you will. But I thought it was just the way that he explained how AI works. And he's like, listen, we're pulling this stuff from the internet. It's not magic. Right? The information where it's, garbage in, garbage out in a lot of ways. It's amazing that we can do some of these things, but he just said like people need to temper their expectations a little bit. And it's still going to be amazing. And that's why, again, I think like we could see some sort of washout and it be a wonderful buying opportunity because this stuff happens
Is this
later.
a Silicon Valley hedge? Like how do you describe what he was just saying?
Yes, I think sometimes in Silicon Valley, the euphoria and can you imagine what the future is going to be like gets a little too ahead of itself. And so I think that you're right. That was a little bit of like just everyone pump your brakes just a little bit.
Well,
he wasn't saying
certainly you could say like, hey, listen, private investors, maybe don't give this unproven company with no revenue an $8 billion market cap. Like, sure, yeah, I would agree.
So anyway, it's worth your time to listen. All right. Speaking of AI, so Stitch Fix, well, I'm still a client of. I don't think anyone else is because the stock, gosh, it crashed like 90%. And I'm so glad. I bought this thing in the meme stock mania after the CEO was on Patrick's podcast, and I don't know, I made some money in it, and then she quit, and that was enough for me. Like, okay, the CEO quit. It was her vision. I'm out, and then the stock crashed like 90%. It's a typical meme stock. But I still use it. So once every 2 months, they send me a box of clothing or shoes or jackets.
Do they like recycle the brands, or like are you familiar with the brands that they use?
It's a lot of them have been newer brands to me, and I'll write a note. Hey, and probably it is AI at this point, but I'll write a note. Say, hey, I'd love a new jacket. I'd love some new joggers. It's fall. I want a hooded sweatshirt, and then I pick and choose what I want, and then I send back the rest. And it's gotten me a lot of new clothing that I never would have got before.
Wait, do you not shop on Instagram?
Not really. No, I'm not. I don't go to Instagram that much for whatever reason. I probably should. It's probably better for me than Twitter. But anyway, they have this new AI thing in Stitch Fix where you upload a picture of your face and a picture of your body, and then it allows you to see what clothes would look like on you. So I uploaded the pictures of what they put of me in here.
Are these both fake, or is the one on the left you?
No, they're actually not me. Come on, I've got a better build than that. It looks like I skipped leg day, and
the one on the left does look like you. I mean, the one on the right looks like you too, but
it kind of does. Well, I uploaded a picture of my actual body, so they had something to go off of. The one on the right is obviously not me. But yeah, you're right. The one on the left, it kind of looks like me.
So Ray-Ban has this feature too, where you can like they hold the camera up to your face, and you could like put the glasses on, and you can look around. It's pretty cool.
Right. So anyway, I thought it was kind of. I did this in 10 seconds.
Yeah, I don't know.
And then it took.
I don't know if this will change the GDP. But
right.
But it's pretty cool. All right. JP Morgan plans to allow institutional clients to use their holdings of Bitcoin and Ether as collateral for loans by the end of the year in a significant deepening of Wall Street's crypto integration. That's a report from Bloomberg.
So I guess just having this is the stuff that got crypto in trouble a few years ago, right? Obviously, the borrowing against.
No, hold on. That was investors borrowing against and loaning and all that sort of stuff. I think that this is maybe less for like that cowboy shit, and maybe more for like less insane margin.
Yeah, like a portfolio margin loan, like a typical one.
Right.
But yeah, that's what I'm saying. That's a step in the right direction versus the cowboy stuff.
Yeah. This surprised me in the story. Morgan Stanley plans to allow customers on its E-Trade retail platform to access popular cryptocurrencies beginning in the first half of next year. They're still not. If you're a Morgan Stanley client on E-Trade, you can't buy crypto.
I gotta be honest. I didn't know E-Trade still existed.
Yeah, Morgan bought it.
But I didn't know they still even I thought they just kind of consumed it. I didn't know that people actually still used it. So it's just Morgan Stanley customers, obviously. That is a little surprising.
Well, I guess no, I don't know. I honestly don't know what they're talking about, because I think if you are an E-Trade customer, technically you are a Morgan Stanley customer because they own the product. But I don't know exactly what they're referring to, how they break it down. Okay. But anyway, Vanguard is coming too. There's some whispers that Vanguard's going to allow it on the platform. We'll see. All right, on the
and an ETF or no?
In the ETF, I believe.
No. And are they going to do a Vanguard ETF?
Oh hell, I mean, I would be shocked.
Probably not,
No,
right?
you know what? No. All right. On the crazy side of things, Punk 9059 tweeted. Remember, we spoke about this company a couple of months ago, ETHZilla, and we said that this is crazy. If you think, and I don't know if ETHZilla is this company, but there were companies that were like reinventing themselves as crypto treasury companies where they're trying to like transform a non-existing or shitty business into these treasury companies, and that was going to work. Well, obviously it's
Right.
not working. Look at this chart of ETHZilla. Shot up to like $100 on the announcement. Now it's down to $20. But the trouble is that they sold $40 million worth of ETH to fund stock buybacks. So yeah, it's not working. I have an update on MicroStrategy that I asked ChartKit to do a couple of weeks ago, but haven't gotten around to sharing on the show. We'll do it next week. Let's just say that
So the stock is basically flat on the year. It's interesting.
flat on the year. So I think I think this was a SPAC prior to, so I don't know what it was like in the beginning of the year.
No, I'm talking about MicroStrategy.
Oh.
So Bitcoin's up 25% or something, and MicroStrategy is up 2%.
But if you look at MicroStrategy divided by BTC, it is at multi-year lows. So
the spread is
not working. And I'm curious to listen to their earnings call and see what he has to say. All right. We are not seeing a pickup in activity in the real estate market, residential real estate. Neil Dutta said, despite the decline in mortgage rates, we've yet to see a pickup in purchase demand. Mortgage purchase applications slid 3%.
See, Neil Dutta's on Team Ben Carlson. Like last week, I said, because if you think about it, mortgage rates topped out at 8. Now they're back down to 6, and you're still not seeing a huge uptick in activity. I think it's got to be lower.
I think that this reverses. Like, yes, I think that you are right. Clearly, it's not showing in the data that lower rates are having an impact yet. So I don't know if it takes rates breaking 6%. I don't know if there's a psychological number there, but I do suspect that if rates go down a little bit more, that you're going to see.
I honestly think we need lower housing prices. I think that's the thing. That's going to be more meaningful than lower mortgage rates. Maybe I'm wrong. Lance Lambert had this thing where he looked at housing markets where the home prices are falling. And he said among the 300 largest metro area housing markets, 105 markets saw home prices fall year over year between September 2024 and 2025. To me, this is a correction for ants. So the worst one is Punta Gorda, Florida, which my grandparents used to live there, actually. Nice little area. Englewood Beach, very nice. Yeah. So there's 2 housing markets, both of them in Florida, where they're double digits. It's 12 and 10%. But you look at these other places, you're seeing home prices fall 3%, 4%, 5%. 6%.
That's nothing, especially if you zoom out.
It's nothing compared to the gain. So how about this? What if more activity, one of the reasons that we're not having activity is because the price point is being held up. What if more activity actually led to a housing price decline? If there was more activity, then you'd see the true price of these that people are willing to buy at, and it's lower.
Could be.
What if more housing activity didn't lead to higher prices but lower?
Could be.
Is that too galaxy brain? I think that's possible, that it's the price thing. People are hung up on the prices.
I don't know. That sounds too cute, but maybe. Maybe. All right, let's talk about private markets. Ben, we spoke with Shonali Basek last week from iCapital, had a very good, clean, spirited debate about what's going on in private markets. One of the stories that we didn't really get to was an article from the Journal. Wall Street is pushing private assets into 401ks. We asked whether anyone wants them.
I hear this a lot from people when we talk about private investments on any of our stuff. A lot of advisors will say none of my clients are asking for this.
Yeah, I've said this. I've told the story multiple times. When we were at Future Proof last year in Colorado, I was hosting a talk and I said, show of hands, like how many people are being asked about private markets from their clients? And everyone looked around and not a hand went up. Now, and I said, like, is the private market, are we being gaslit by these asset managers? Now, the answer is no, because the flows are there. Blackstone reported record flows. It's not happening. I just think that it's coming more from the wires than the independents.
That makes sense. And I think the independents that do have people who want it, it's the ultra high net worth.
Yeah.
It's people with call it 20 million and above, or it's much higher level.
Yeah, so it's definitely, again, it's definitely not nothing, but I think that the asset managers are maybe overestimating demand from the REAs. We'll see. But anyway, to this survey, nearly 40% of respondents reported never having heard of private credit funds. That actually sounds low. Like, who's heard of private credit funds? And like, what normal people have?
Yeah, that's true. Yes, if I asked my mom and dad or my in-laws, like how many of them would know what private credit fund is? No, probably not.
Yeah, they would say, "What are you talking about?" All right. So 45% of respondents said, "I am satisfied and have enough offerings." Another 45% said, "I am satisfied, but would like more mutual fund offerings and ETFs." And then 10% said, "I am dissatisfied with my 401k options." And what
I'm
more?
surprised that number is not higher.
You know,
There are a lot of crappy 401k plans out there.
I haven't spent as much time here in that side of the business as I used to. But we used to see a lot of shockingly shitty options. It's like, throw a target date fund in there. Or why is this target date fund 115 basis points? What's happening here?
Yeah, I guess that a lot of that stuff has been wrung out, but there are still these tiny 401k plans that aren't that great. But
anyway, whether or not people are asking for it, it's coming. All right, so here's
but if people don't ask for it, it's coming. Who buys it? Is there only way in?
It's target
the back door through target date
funds. Yeah,
I think the adoption is going to be slower than you think.
Why are you putting dollars in my mouth? I didn't say anything about the adoption.
I feel like you've been relatively paper bullish on this.
Oh, I think I'm bullish. It's coming.
But I'm saying if the consumer pushes back and the RIA pushes back, you need an end investor.
I don't.
Just because it's offered doesn't mean it's going to be.
Oh
huge.
yeah, no, hold on. I don't know that I'm super bullish on demand, but I think that if it gets its way into target date funds, then boom, game over. I don't think that you're going to have like individual investors be like, "Oh, where's my private credit? I don't see my private credit in this lineup." Like, I don't think that's going to happen.
Right. I wonder what that looks like. I guess if it's a 10% allocation and the fees are really high, it's not going to push the total fees to the target date fund that much higher.
I think that part of the good thing about them coming into this sacred world that nobody wants them to be in, and I'll say, like, I don't think that they need to be there, but they are, and it's not my decision. I think more transparency is better, and it's going to bring down fees.
Yeah, I agree.
If it works, fees are going to come down.
And it's gonna bring out much more transparency with the underlying companies as well. Like you said, there was the 2 bankruptcies in private credit, and everyone was talking about them. You would have never heard of these companies otherwise. Like there's going to be more demand for information about these companies that they're investing in as well.
Yeah, hopefully. So listen, do I want it? No, but am I hemming and hawing and saying that people aren't going to be able to retire because they were fed 10% of private credit in their 401k? Come on. All right. So
yeah, but the thing is, baby boomers. So I guess to counter myself, I'm pulling a Michael right now. I'm arguing myself. Baby boomers who are retiring, who want to de-risk a little bit. Their private credit is the easiest sale of any private asset class, bar none. It's way easier to sell than private equity, venture capital, infrastructure, whatever, hedge funds, because it's just yield and it's like a fixed. You just say, hey, listen, it's a bond fund that you can't get out of, but the yield is 10%. You think retiring baby boomers aren't going to sign up for that? Like that's the kind of thing that maybe that's the end user. That's where the biggest bang for your buck is.
Mm-hmm.
Of course, put 20% of my portfolio in that, 20% in liquid bond funds, 60 in stocks. I'm good.
Yeah.
That's going to be a thing.
Yeah. Okay. So I've been, I don't know if harsh is too strong a word, but I've called out the FT and other journalists that so desperately want there to be multiple cockroaches because it's juicy, it's salacious. And listen, I get it. However, I want to call out a report, an article, What's Up with Private Credit Ratings by Toby Nangle from the FT. This is great work, and reading this article definitely makes you go, wait a minute. So there is a thing that's happening in the private asset world where a lot of these giants are buying up insurance companies who are buying a hell of a lot of private credit. And you talk about the circular dealing that you see in with OpenAI and all that sort of stuff. You're seeing a lot of that here. Now, I don't know that asset manager X is buying insurance company Y, and insurance company Y is eating the private credits from asset manager X. I would imagine that there's some sort of Chinese wall there. This is not my universe, so I don't know, but I would imagine that's a faux pas. Okay, anyway, insurance companies are buying a lot of private credit, especially in the US and Canada. Now, private credit is not all bad. There's a lot of different types of private credit. There's direct lending, which is, I think, the thing that most people are talking about. But there's commercial real estate lending. There are residential mortgages. There's asset-backed finance. There's infrastructure. So it's not like all direct lending. Okay, but this is the part. So from the article, as the IMF wrote in last week's Global Financial Stability Report, most insurers' exposure to private credit is classified as investment grade. But investment grade, according to who? Now, these insurance companies, even if they're owned by these asset managers, are still highly regulated, as they need to be. So investment grade, according to who? Mostly, it turns out, not according to Moody's, S&P, or Fitch. So check this chart out. The number of securities that Moody's, S&P, and Fitch collectively rated stayed pretty much flat between 2020 and 2023. But the total number of privately rated securities ballooned over that period. And it was the little guys that scooped up this business. Now, you might say, Michael, who gives a shit about the big three? Like, what did they do to protect investors in 2006? All right, fair, I suppose. Okay, back to the IMF. I'm sorry, back to the FT. Okay, this part is from the IMF. So insurers' search for private credit exposure classified as investment grade has changed the rating landscape in the United States. Misclassification of below investment grade instruments into the investment grade bucket may result in default losses significantly exceeding those expected during an economic shock, leading to the erosion of insurers' capital and potentially causing liquidity gaps because of insufficient cash flow from the defaulted entities. Now, if there is like a systemic risk, a holy shit type of risk, where there's like a liquidity drain and like selling of illiquid stuff that can't be sold, I would say that maybe this is the part to keep your eye on. This is like a little, this definitely, there's smoke here. Now, I'm not saying there's a fire, but this definitely makes you go like, wait a minute.
How about this? A lot of people are concerned about the circular nature of much of what's going on in the world right now. Right? All the technology companies are investing in each other.
Here, you hold my bag, I'll hold your bag. Lend me your bag, I'll give it back to you.
All the private equity managers and private credit managers are investing in these things. But to me, I think that's actually the right way to do it. Instead of going on an island and doing these things by yourself, if everyone is involved and it's a systemic risk, guess what? Someone's getting bailed out. I said this on TCAF the other day. That's what's going to happen. Yeah. If these things all get big enough and they're all part of it, no one is going to let this stuff all go down.
Yeah.
They're all too big. They'll shore each other up.
Yeah.
If there's one, right?
Yeah, top me off. I'll get you on the next one. All right, but here's the last one. And this is look at this chart from the FT. Seriously, credit to them. This is a great report. So they break it down. Obviously, not every insurance company has the same allocation. So they show the top 10 holders of private letter rated bonds. So Global Atlantic, the insurer, 100% owned by private equity group KKR, leads the pack with a quarter of its $100 billion portfolio carrying private letter ratings. Mass Mutual holds more than $50 billion. Other insurers like New York Life, now New York Life is not owned by one of these companies. New York Life had a measly 6.7% of their bond book privately rated. This is good reporting.
Okay, good stuff. I just think the biggest firms have realized if we're all in this together, just like the tech firms, like if one goes, we all go, and we'll be fine. I think that's actually the right. It sounds like a systemic risk, and it probably is, but I think it's actually good business.
Okay.
I think it makes sense.
So we had a great question, and I apologize because I forgot to really give this too much thought. But it was this: if you were on a deserted island, which 3 earnings calls would you want to hear to help gauge how the U.S. economy / stock market was performing?
Wait, yours would be Visa, MasterCard, and American Express. You love the credit card companies.
I mean, well, yeah, they do tell you about the consumer. Now, okay, this is a really good question. And I would say, like, I can nitpick and say, like, well, tell me where, like, are you talking about, like, in a normal time, in a period of, like, distress? What would I want to look to for, like, a leading indicator? Things getting better?
So if you want to get, can I do mine first?
Sure.
I just want to get really broad and have everything covered. I would say JP Morgan for the finance side of things, Walmart for the consumer, Apple for high-end consumer.
Yeah, not bad. That's a good list. So for
the boring list.
Well, it should be. For finances, I would have said Bank of America. because they serve more of a Main Street. I mean, they serve everyone. JP Morgan is a little bit of a higher clientele, but splitting hairs. I also would have said Amazon as opposed to Walmart because they touch more of the economy. And then the third,
You got to pick one of your credit card companies. That's your favorite, or do you think?
Well, I already
that
got a
picks up
financial.
Bank of America?
I already got a financial.
Okay.
Yeah, I mean
Delta?
No. So you know what's interesting about Delta? I was thinking about this. This is not a deep, and this is not a hot take. It's just so obvious. One of the reasons why people are able to travel more with their families, and Delta is doing what it's doing. I would love to know what percentage of family vacation flights are paid for with reward points. So we just booked our flights to Disney, and they were whatever they cost, a couple $1,000s. Guess what? Paying with points is obviously a meaningful decision for almost every family that decides whether or not to take a trip. It's a huge amount of money.
It does make it easier. Yeah, I have 3 kids. We're buying 5 tickets every time we fly. It's expensive. Yeah, I agree.
All right, so what's the third company? Yeah, I don't know. I guess. Well, Apple's like not really representative of the economy. Oh, but it is for the stock market. Aklo? Nah, rigatoni.
All right. A bunch of people sent us this. There's a YouGov study about horror movies, saying horror movies have the smallest share of people who collectively like or love it, as well as the largest share of people who like or hate it. So hate or dislike it. So I think the chart just shows that people, you either love horror movies or you hate them. It's a very extreme. Everything else is kind of more down the middle.
Well, yeah, nobody's like, yeah, I could take it or leave it. What do you mean? Horror is polarizing. You either love it or you hate it.
Yeah, so a lot of people said this is Ben and Michael. So that actually does make sense to me.
But most people that don't like horror, don't like it because it's too scary. The fact that you don't like it because it doesn't do anything, you don't feel anything, that's kind of psycho. You're kind of nuts.
You know, this happens in my life sometimes. I feel like I blame investing. Like the whole point of it, everyone has been telling you to take your emotions. My wife always says like, why don't you show more emotion about this? Like show more enthusiasm and I'm just like I'm always, yeah, I don't know. I think that's the same thing with horror movies. It doesn't, the emotions I've stamped them out.
I was thinking about back to my horror movie.
I'm the Tin Man basically.
Yeah, you are. Back to my horror movie list. So Kobe is turning 9 in February. I can't believe my dad took me to see In the Mouth of Madness when I was 9 years old. That is so insane. Kobe watches.
I've never heard of this movie.
He only watches like How to Train Your Dragon and whatever. Like In the Mouth of Madness. Dad, what are you, insane?
I think you're going to take George to see Howard Boy someday. So he got into Beetlejuice this week because for some reason that came up after Tremors. And boy, did he love Beetlejuice. He already is watching the second one, which just came out a couple years ago, which was not very good. So he's going to be big time into it. He can't wait to watch horror movies.
There's a scene in The Mouth of Madness where Sam Neill is dreaming. And he's on the couch and he looks over and there's like a guy with a monster looking face. I don't know, a dilapidated face. And like he wakes up out of the dream and it's scary. Like that dream sequence is scary. He snaps out of it. He's sweating. And then he looks over again and the guy's there again. And it was a dream within a dream. I was 9. Anyway.
I was scared back then too.
No, I'm fine. It's totally fine. No big deal. All right. Last week we were talking about like car repossessions and maybe making a little bit light of it. Like if you zoom out to 2019, it's where we were. Yeah, I want to take the other side of that. I mean, giving up your car, like having your car repossessed, that's the last thing that you stop paying.
Yeah, I agree. So it's increased quite a bit, but we're back to 2019 levels there again too, which was high historically.
But who cares? But it's still pretty elevated, and compared to a couple of years ago, like it's just. And also, if you think about, all right, I know we throw around numbers a lot, and it's like they lose context because they're so big. 1.73 million cars that people had to let go.
How many cars are on the road?
Doesn't matter. I'm zooming in.
Oh, you're zooming in. Okay.
No, I'm just saying that's crazy.
So there's 300 million registered cars. So that's what? 0.4% of the total?
I'm just zooming in. I'm just saying,
Yeah.
like, on a human level, that's insane.
I agree.
All right, Ben, this guy said, like, Ben, you think you're good with credit card rewards? Hold my beer. Okay, tell me if Ben can do better than this. My family just grew with our second baby last month. They traded in a RAV4 Prime for a used 2023 Honda Odyssey.
Good choice.
After trading, it cost $22K. I paid $5K using my Robinhood card for 3% cash back and financed the rest. You with them so far?
All right. Yep.
Here's the twist. I opened a regular auto loan at 5.29% APR. I'm opening a Wells Fargo Reflect card with 0% APR for 21 months and a 5% fee for balance transfer. I will pay off the auto loan. I'll pay the minimum each month while putting what I would have paid toward the car loan into market CDs around 4%. I'll close them before the 21-month period, then pay off the balance or I'll part into another 0% offer. This is like the Zach Galifianakis meme. Even without a car purchase, all right, whatever. How much money is this person saving? Is there any juice here?
Probably not a lot, but honestly, for people who do this, go down this rabbit hole, for them, it's more the game within the game than it is like, because it'll probably be like, I don't know, with the interest that they're making over 21 months and the interest they're saving, it'll probably be $500. All
right, well, guess what? It's a personality type. My uncle was a huge coupon guy.
I can't throw shade. I would have done something like this.
Would physically take coupons, I'm sure he still does, to the grocery store. And he was definitely like, oh, this guy. He was this guy at the grocery store. Like, everybody knew him. And so it's a personality type. So that helps explain this tweet that went viral over the weekend. Somebody tweeted, the only good mortgage is a paid off one. Our biggest monthly expense is gone. And they showed, and I'm sure that they knew that this is going to kick the hornet's nest. The rate was 2.625%. Now, objectively, this is a subpar financial decision, objectively. I mean, if nothing else, there's a spread between what you get in risk-free bonds versus 2.625%. However, and people got all up in arms. It's like, guys, we know. He knows. He understands what he's doing. He understands that there are better uses of money, but it doesn't matter because there are people who are debt averse regardless of the interest rate. And can't you understand their point of view, even if you disagree with it? This person feels good about not carrying a mortgage, not about having his biggest monthly expense gone. And I'm sure he's fine otherwise. I'm sure he's got plenty of assets. So this is not a financial decision. It's a personal finance decision.
Listen, I'm of the opinion that there is no black and white in personal finance. There's only gray. This is black or white. This is an insane decision.
No, it's not.
Insane. It's the inflation rate is 3% right now. You can get 4% in treasuries. I don't care how you feel about debt. This is an insane decision.
No, it's not. It's not.
That's how I feel.
It's not insane. It's not insane. It is a bad mathematical financial decision, but the psychological hurdle or benefit of not having
sometimes you have to take the behavioral stuff out of it.
No.
Listen, we all are in tune with behavioral psychology now. It's a big thing.
Yeah.
Sometimes you have to take it out of the equation. Sometimes it's not worth the behavioral psychology, and you have to just eat your feelings.
All right, how about this? Let's say that his mortgage is $3,000 a month. Okay? And this person, so you're saying, well, the spread between
what's safer, having your mortgage paid off or having $200,000 in the bank?
No. Listen.
Which one's safer?
Hold on. Now you're talking extremes. If you're saying the mortgage payment is $36,000 a year, and you're saying that you could capture the spread between 2.625 and 3.75, 1% on $36,000, who gives a shit? It's effectively $0 for this person. Now,
but what's more? He's putting all of his money in this illiquid asset. What's safer? I'm saying having that liquid cash or an illiquid asset.
Oh, I get it, but I'm sure that this person has their finances in order, and there are other liquid assets.
Yeah, and it's still a bad decision. That's where I fall.
For the general investor, for the average person, somebody said to you, "Hey, listen, I've got this 2.625% mortgage, and I know it's a good rate, but I just don't like paying the monthly rate. I'd rather pay it off." All else equal, for everybody, you say, no, don't do that. Don't do that. Like, just don't do that.
100% of the time, never pay it off.
Yeah,
never.
But for somebody whose handle is barbell financial, I'm sure they're making the right decision for them.
And it's still a wrong decision.
Okay.
That's where I fall.
Last week on Netflix's earnings report, they said that the quote, so engagement remains healthy. We achieved record share of TV time in Q3 in both the US and the UK. Yes, sure, that is factually true. But if you look at the share of US streaming time, whew, Netflix is getting smoked by YouTube. There's no other way to put it.
Honestly, we asked this before. When's the last time Netflix had a good show?
A good
It's
show.
hard to come up. Netflix,
When you say good, do you mean like a HBO type good?
I mean, they had Adolescence this year. People pointed to. I didn't care for it as much as other people, but they haven't had like a show this in the last, I'd say, 2 years that it's been like, whoa, this is a water cooler show. They haven't had anything.
Have they ever? I mean, House of Cards was, but
Squid Game. They've had a
Squid Game. That's true. Okay. So this morning, my puppy woke up at 5 o'clock, and which she never does, but she was pawing at the door, so I let her out and went downstairs on the couch, and I couldn't. I was up, so I turned on Netflix, and I see this #1 movie, and I had never heard of it, and the cover is an actor that I like. The movie is called
House of Dynamite. I'm guessing
House of Dynamite. So I Google it. Woo, Catherine Bigelow. Catherine Bigelow did
Hurt Locker.
Hurt Locker, Zero Dark 30, Point Break. I said, holy shit. First of all, when did that drop? Did that drop yesterday?
Friday, I think, yeah.
Oh, Friday, okay. Anyway, a lot of fun. Did you watch it?
I didn't watch it yet.
All right.
You're into it?
So it is a missile movie. Like missiles are in the air and holy shit, what's happening? And it's good. Didn't finish it, but it's good. Anyway, yeah.
I heard the ending sucks.
You heard the ending sucks?
Yeah.
Why would you hear how would you hear that? Why would you hear that? Why would you ruin it for me and the listeners?
Maybe I'm lowering expectations for maybe the ending will be better than you think.
Wait a minute. How did you hear it sucks? You read spoilers? What's wrong with you? I raw dog everything.
I just saw a bunch of people say, hey, watch House of Dynamite. Ending sucks.
Okay. All right. Thank you.
I saw multiple people say that. That's all.
So this is a big deal, a big deal in the world of streaming. Taylor Sheridan of Yellowstone, Lioness. What else did he do? The Billy Bob one, Landman.
Tulsa King, Landman, Mayor of Kingston.
So the biggest TV show creator in the world is leaving Paramount. Now this is a weird story because his deal with the studio, the movie deal, is up at the end of this year, but his TV deal goes through 2028.
He did Sicario too. Yeah. He should go back to movies.
Yeah. And he did Wind River, I think, with Jeremy Renner that was going. But his deal with Paramount, the TV studio, is through 2028. And me, you, and Josh are talking about this, and you guys have the right take. Credit to David Ellison for selling all the way at the top. I mean, by 2028, how much more juice is this guy going to have left?
Right. He's got to run out of ideas eventually.
So anyway, and NBC Universal probably gave him a giant bag of money. So I think
you're paying a 50x cape ratio for Taylor Sheridan right now.
Yeah, big mistake.
All right. When did Halloween decorations become a thing? Because when I was growing up, there was some decorations, but the Wall Street Journal has this thing: pumpkin scapers are making a killing. As fervor for the season reaches new heights, families are paying north of $1,000 to create Instagram perfect tableaus for porches and front yards. I feel like the Halloween decorations have gone crazy, and I have a take. I think it's all millennials. I think this is a millennial thing. There was some people who would decorate for Halloween, but now it's almost like Christmas levels.
You don't do it, do you?
No, I mean, we have a couple of pumpkins. We carved pumpkins last night. I did pretty good last night. We had a whole toolkit of pumpkins. I'm like Billy the Butcher here, pulling stuff out.
I'm a horrible carver.
It's hard. Yeah. My hands, I had like carpal tunnel today. But we did, what's the Nightmare Before Christmas? We did a guy like that.
Jack Skellington.
Yeah, it was very hard. Yeah. It took forever. Looks good, though.
Good for you.
Kids are happy.
All right, so I got a lot of emails.
Wait, are you a Halloween decorator?
Robin always gets the same stuff, like a bale of hay.
Yeah,
and some pumpkins,
but not like the giant skeletons and the blow-up inflatables.
We're not weirdos. No offense to anybody that does that. Actually, you know what? I'll take that back. Well, no, I don't take it back. How about that? I actually, I appreciate. I think it's odd, but I do appreciate the people that do it because my kids love it. So if
my kids do too, but it's never going to be our house.
If you are entertaining the community, you're not weird. You're a good citizen. Good for you. Okay. I got a lot of emails about my extenders. So apparently, my thing was all up. Verizon came in here and I was like not paying attention to when they were here. I think I was doing a podcast or whatever I was doing. I was on a call, who knows? And so we got, they came with Eros, okay? That wasn't working. Then I bought the Verizon extenders and that definitely didn't work. And the whole reason why I had Geek Squad come the other day, my Eros weren't plugged in. Can you believe it?
Is that on you or on them?
So Verizon labeled, all right, so there was a Verizon 2.4G network, a Verizon 5G network, and a Verizon 4. Turns out the Verizon 4 was just the name that the Verizon dude gave to the Eero network. He labeled it Verizon 4, and I wasn't paying attention, or I don't know. So I'm like, why did he label it Eero? So I knew that it wasn't a Verizon network. Everything should be on the Eero, except now I thought I had 3 networks. Anyway, we're good. I just had to plug it in and connect everything to the Verizon 4, which is not Verizon.
That sounds like it's 90% on you.
Very frustrating. Probably was. All right. Okay. All right. I listened to American Prometheus. I didn't much care for Oppenheimer, the movie. And I think I loved it. It was too long.
I read the book after I saw the movie. Sorry.
You read the book after you? Oh, me too. So I think it was a combination of hand up. It was too long for me, and I might have taken more edibles than was appropriate. Okay, 3-hour movie, edibles. You're an idiot. My bad.
Yeah, you gotta really turn the crank up on Oppenheimer. Well, why would you take an edible for Oppenheimer?
Because somebody said, "Do you want an edible?" And I said, "Yes." Okay. Simple as that. I wasn't planning on it. Just happened, Ben. All right. So the book was amazing. Not to be that guy, but the book was great. And it made me think about Dan Wang's breakneck analogy of data, of engineers versus lawyers. The fact that Oppenheimer's life, he was ostracized and vilified and tormented and destroyed about him having ties or political affiliations or friends within the Communist Party is mental, right? Like he should have been the most celebrated, or I know people have mixed feelings, obviously, understandably, but he was, and he wasn't vilified because like he created the bomb. It was like he was leaking information allegedly, which I don't think he was. And if this was, in China, he would have been a hero.
The sad thing is that he was a scientist and he was building real things. And today he would work in Silicon Valley and work in software.
Yeah.
Right? Which is kind of sad when you think about it. Like you go to where the money is, and I understand that decision, but there aren't enough people who are building things in the physical world anymore.
So
that's the whole point of the Dan Wang book.
I did rewatch Oppenheimer, and it took me 2.5 sittings because it is so long, and I naturally enjoyed it much better the second time.
Okay.
No edibles.
I think Emily Blunt is fantastic in that movie too.
But she had such a small role. So Kitty Oppenheimer was a big character in the book. Obviously, it's his wife, and she was. Yeah. By the way, they like to drink. Wow.
Yes. People, but I think there was just nothing else to do, so people just drank.
All they did was drink martinis.
Maybe the whole thing about young people not drinking as much today is not as much about being health conscious and such. Because let's be honest, this whole country is not very health conscious. Maybe it's just there's more to do now. And back in the day, like what else were you going to do besides drink?
Yeah.
Right? Okay. We started watching Nobody Wants This season 2. That's the Adam Brody, Kristen, what's her name? Kristen Bell show.
It's cute. I don't watch it. Robin watches it with me, but it's cute.
It's not as good as the first season, but is still having a romantic comedy in my life. That I love the Jonah guy from Veep that's in it, the tall dude.
I did catch the one scene in the first season where one of them is texting about how annoying the brother is or how dumb or whatever, and it's like through the car play.
Yes, it reads back. Yes, it's the first season was better than the second season, but it's an entertaining turn your mind off show that you can laugh about occasionally. And there's a Succession reunion too. What's Kendall's friend's name?
Oh, I know that guy. Yeah.
Okay, he's in it, and Willa is in it too. So anyway, not a bad show.
We need another Succession.
That's never happening. That's like saying we need another Apple. There's not going to be another Succession. Come on, Succession like show. Okay,
no, just like a great show that everybody is all in on.
I think like 2 million people watched it every week. Wasn't as big as...
I know, but our audience was all in on it.
True. All right. Animal Spirits at thecompoundnews.com. Thanks everyone for listening. emailing. What's our what else we got? Anything to plug?
Eh.
All right. See you next time.